We know what's happened. And of course, I'm going to show something in a little bit as well. But let's just take a look here. I'm going to go to SPY. I'm going to click on quotes. It's just going to allow me a quick link here. Let's go ahead and go to the chart. This comment a little bit deeper, a little bit steeper that we've seen from QQQ. We have are in the process of our tariff discussions and everything along those lines, and a lot of blood in the water, a lot of red, and everything along those lines. We had the pausing of the tariffs here. We gained about half back, a little bit more, and then we of course lost that back. So had those big declines, dropping down here from about 560 down almost to 480 at one point. This is on SPY, as I mentioned. So we're looking at an 80-point drop there over the course of a few days. We gained half of that back, a little bit more than half of that back, almost hit 550, and now we've settled into more of a calming turn with the ups and downs, and every time something is X'd, tweeted, anything along those lines, and we're getting some fluctuations. We talked about this back in December. We talked about the risks going forward into the market. We had a great surge in January and February, and now we're kind of in these pullback approaches, a little bit of recovery, and then another pullback again. We knew that there was going to be economic flux with the plans of the new administration. We knew that there's still global strife going on in various parts of the world right now. We talked about ideas for hedging the positions, illustrating, of course, the married put approach to control risk in the bulk part of your portfolio that you want to protect, adding the put options or buying new stocks and adding the put option to control risk to 5, 6, or 7%, and then having the 13 different income methods discussed in our full course, the blueprint, to help you lower that initial at risk and potentially bulletproof the trades as well. We talked about VIX calls. We saw VIX hit, I think, $59.60. I don't want to say cents because it's based on future expectation. But we saw the VIX hit values that we haven't seen since 2020 during the pandemic. And, we talked about in December and even in January, we saw VIX at lower levels once again. We saw it at those lower ranges of 11 and even 12. There we go. And we talked about buying calls on the VIX, and approach there to use, and just is now time to buy calls on the VIX. Well, here's one of those ironic terms. The volatility of the VIX is still too high. The volatility of the VIX options is still very high to buy right now. Could it go back up to these levels? Of course, but we're starting to see what we commonly see with the VIX, meaning that you have an event and the VIX suddenly pops and then it sort of pulls back. You have an event and then a few days later it pulls back to where it wants. You have an event and then it pulls back slightly, and then boom, this stuff here. Yes, I did make money on VIX calls in the past 10, 15 days. I will say that honestly, because when it was down here, even though it was at 20, we knew on April 2nd that those, it was April 2nd, I believe. Yeah, that those tariffs were going to be announced. I took a flyer on a few contracts, 5 to 6 contracts, 8 contracts on the VIX, and closed most of them probably up in this range here. And of course, one of the other things that we like to discuss, you've heard me talk about it before in the past, going back to going back to the chart of SPY. One thing that, let's go back to the year to date and get that chart up there. My apologies. This is pretty close to the year to date, but what we've been doing, we talked about it in 2020. We talked about it again in 2022 when everything was going on with inflation fears. You had Powell coming out after a meeting on a Wednesday at 2:30 in the afternoon saying what he was going to do, and the market went one direction or the other. And then he came out Thursday morning and the Fed did what they said they were going to do, and the market gave back half of what it lost. It gained back half of what it lost, or even 2/3 of what it lost, or it lost 2/3 of what it gained after he said he was going to do. So it was a hard time, but what was an interesting play during those periods was just buying strangles, or even straddles, but they're a little bit more expensive, but buying straddles or strangles on SPY or QQQ, one of the broad-based indexes or ETFs. And then when you get a rise, then maybe you just reset it to this level here, and then you get a fall. Okay, so it falls down, and I'm buying a put and buying a call out of the money, and then the downturn happens. And so then, okay, we were here, but now let's reset it to this level. So I've got an out of the money put and out of the money call here, and it continues down. Maybe I reset again at this level on the straddle or strangle, and then it moves up. No, not quite enough, but then it moves down. Okay, great. Now we're looking beautiful on this aspect. We reset it to this level, the current price, with an out of the money put and an out of the money call. Now we're moving back up in this direction. It's an idea. The volatility is really high to buy, not super high. We're not talking about high volatilities that you'd see on a pharmaceutical or anything along those lines, or a stock that has earnings like Palantir or something like that that's very volatile, that has earnings coming up in the next 10 or 13 days. But the volatility of SPY, the volatility of QQQ, the options, the implied volatility of the options is very high right now, so it's expensive. Might not be really the best time to get in, but these types of market fluctuations that we see, these are some of the ideas. Those VIX calls, straddles or strangles on the SPY, QQQ, something to add a little bit of extra protection in your portfolio for volatile times. We talked about it in December. We talked about concerns, what's coming up in the market, but these are some ideas now. Now, I'm still in married puts. I have married puts that are down 30%. The stock's down 30% from when I bought it, but I'm only losing 1.3%. I just opened a few bull put credit spreads earlier this week. And you think, Mike, why would you do that? Well, I thought that things were going to calm down and recover, and they kind of have. And they both went into the red, but not to my closing price, 50% loss. I was going to use the pendulum adjustment on one, but I held off, and it worked out okay. It was on Costco. It was one of them at about 9.29. I think my strikes are 9.10 and 9.05. Let's take a look at where Costco is today in a moment. But taking a deep breath, taking a step back, seeing where things are, those are some ideas we talked about in December. We're seeing the market sentiment go back into the bullish buys. We had the strong bullish buy. I think it was on 4.7. I don't know why it's not showing up on this account, but I saw a very bullish buy on 4.7 and 4.8. We've seen the market pull back up, pull back down again, but here we are trying to recover a little bit. The market, as we can see as a whole, I think, and I had discussions with Ernie on this as well, we're seeing it, even though we're down today, it wants to go back up. It just doesn't want the fluctuation of these sudden news events and these sudden instabilities. Is now a good time to buy? Well, it comes with caveats. Now might look like a good time to buy. I always go by the indicator, the market sentiment indicator. I've closed out some of my bear put positions because we went to the bullish buys, and I was at a profit, a very good profit on those positions. But at the same time, there's hesitation in place. Covered calls. I've had a lot of coaching sessions in the past 10 days on covered calls and cash secured naked puts that are underwater. Okay. Now might be a good time to open new covered calls, but instead of opening covered calls, I don't even have that in my thing here. Let's go ahead and go to other strategies. Let's take out a long call for the moment, but still could be good. Let's go to covered call. And what I would suggest is that if covered calls are your strategy, cash secured naked puts are your strategy, maybe now isn't a bad time to go back in a little bit, but be a little bit more conservative. Maybe go a little bit deeper in the money than you're used to. Instead of selling at or just out of the money covered calls, hoping for growth. Oh, sorry, we're on the simulated CDs there, the far out in time one. A lot of times investors ask me, hey, on your price watch alerts, morning updates, you're sending in the money covered calls. Why? When I do a covered call, I'm buying the stock and I'm selling the call right at the current strike price. Here's X at $40.06, selling the May 40 call 35 days out in time. Maybe you're using weeklies. That's perfectly fine. Could probably get easily filled at the midpoint at 375. We're looking at a good 10% return if assigned at 35 days with still a 9.4% downside protection. That looks like a really good trade as far as a covered call goes. You can't, doubt the numbers. right? The stock stays where it is or moves a little bit up in price in the next 30 days. We're making a 10.2% return. We collected that premium of $375. What does that mean here? That means that we've got a 9.4% downside protection. The stock can fall almost 10% before we're losing money on this transaction. But honestly, whether you're going 1 week out in time, 2 weeks out in time, 20 days out in time, or a month out in time, if that is your general approach, that's perfectly fine. Selling the at or out of the money, looking for the market to move up, maybe not wanting to be assigned, I get it. But opening new positions, maybe we want to be a little bit more conservative in this hesitant market. The implied volatility is in our favor for selling. For cash secured naked puts, for covered calls, other strategies. I don't recommend short straddles or short strangles that are naked in this environment. I can't do it because there's too much risk one direction or the other. But maybe instead of selling the at the money 40 call with that good 10% return, even a 9% downside protection, maybe now it's time to go a little bit deeper in the money. Maybe the 37 strike, maybe the 36 strike. Giving up some of that upside premium, maybe, okay, let's just say we get 545 for this option here instead of the 547 midpoint. Let's say we just get 545 for this call at the midpoint price on X. You're still looking at a potential 7% return. But you collected 545 against a purchase price of 40.06. We're looking at almost a good, 13, 14, 15% downside protection with still the potential to make a 7% return in 35 days, as long as X doesn't drop below $37. And I know this might be considered a bad example. I was waiting for someone to comment on that. No one did. Oh, Mike, you don't know what's going to happen with the tariff war. You don't know what's going to happen with going on with China and the tariffs. And are they going to increase their reciprocal tariffs and we're going to increase ours? I think the administration put it at 145 last night or today, if I'm not mistaken. Someone correct me on that if you have more insight. It had jumped from about a 90% tariff to 125. Now I think it's 145 that they're threatening to China as they threaten back with us. That's going to affect steel and that's going to affect everything else. But of course, other countries, 90-day pause, they're willing to work with the current administration. So we'll see what happens. But that's the idea. The at the money option gives me a potential 10.5, 10.4% return if we're assigned at 40. And we had a 9.4 downside protection, but a 7% return with a much higher downside protection. Maybe that's the way to go. A little bit more conservative, a little bit more out of the money on credit spreads, a little bit more out of the money on cash secured naked puts, a little bit more in the money on the covered calls, or considering going to an approach if you're buying new stock positions with the married put or even long calendar spread collar spread positions. I'm sorry. I'm reading down the line like, where are my collars? My collars aren't here, and I'm on the webinar account, so my long collars aren't here. But short-term long collars, that's something I've opened up my portfolio to as well. Okay. Rod says it is 145, and then we have a comment there as well that China just raised theirs on us to 125. So I must have missed that today. But it's just going to go back and forth until someone can talk to someone and more level heads approach. Now, this all being said, this is what I'm thinking. This is what's in my mind. I opened those two global put credit spreads. They're doing better now. I had a chance to opportunity to manage one with the pendulum adjustment. Didn't need to. We're seeing the bullish buys come back in. I'm going to wait till Monday, of course, to open a little bit more new positions. We want to see how this fades out. As it's commented on, China just raised theirs on us to 125. We're at 145 with them. We know there's going to be fluctuation. We know there's going to be volatility. VIX calls worked well. Hey, they still might work well in a favor if it goes back up to that 60-50 range if this war keeps continuing. If you do want to see more information, of course, what I'm saying is on some of the concepts I just discussed, let's go ahead and go over to our YouTube channel. And I'm just here on our playlist here. So you have technical analysis and power options, collar trades. Let me close this view. about 10 to 15 different strategies and about 10 to 15 different videos, or 10 to 12 different videos in each strategy, walking through the basics A to Z on each one, from entering positions, criteria to look for, pros and cons, basic management techniques, when to look to manage positions, and much more. Even call buying, long calls, long puts, credit spreads, of course, earnings discussions, and more. But you can use the search function, and I just type in VIX. Oh, well, if I can type properly, folks, we'll just type in VIX. There. And let's see what we've got. We've had some recent discussions. That's from 5 years ago, 3 years ago. There's a whole playlist here, discussions on volatility and implied volatility. That's important for understanding options. But, discussion on VIX call buying, inverse volatility, trading UXVY or VIX. VIX is a market hedge from 2 months ago. That's the most recent one. That was a pretty good one. Buying call options on the VIX from 1 month ago. That's when we started looking to it. That's when I entered my position. So these are some recent concepts you can look at as using VIX as a market hedge. Now, normally we wouldn't do it because the volatility of the options on the volatility index, the implied volatility of the options on the volatility index are a little bit high. But if still expecting rocky roads, it's not bad to take a flyer. 2 or 3 contracts with a 0.3 delta that's maybe right now probably at the 58 or 60 even strike, 40 to 50 days out, might be something. But we're seeming to settle. We're hoping to settle. We're seeing what the market's doing. We're seeing what it wants to do. We're just going through the volatility now. We're going through the fear gauge. We're going through the uncertainty, which we kind of warned about in December. And that's what we want to look for. That's what you want to keep in mind. So some strategies are still good to use. Neutral to bullish strategies might still be good to use. Bearish strategies, still good to use. But with the neutral to bullish ones, if you're thinking of at or out of the money covered calls, maybe let's go a little bit deeper in the money for a little bit more protection. Maybe let's go a little bit more out of the money on our cash secured puts, put selling, naked puts, parity trades to the covered calls. Bull put credit spreads, maybe just lighten up. Normally I'm 15% invested in bull put credit spreads with that portion of my portfolio. I've dialed it down a little bit. I only went in with about 7.5%. But at the same time, bearish spreads that were working well, bearish positions, calendar put spreads, bear put debit spreads. Now that we're seeing the bullish buy warnings and the market sentiment, we're seeing that the market is trying to get back.